Introduction to Accounting Controller Role. The accounting controller is a pivotal figure within an organization's finance department, often serving as the chief accounting officer. This role is responsible for the accuracy and integrity of financial reporting, ensuring that all financial transactions are recorded, reconciled, and presented according to established accounting principles. The controller's duties extend beyond mere record-keeping to include strategic involvement in financial planning and operational efficiency. They are instrumental in maintaining robust financial systems and processes, safeguarding company assets, and providing reliable financial data for decision-making. Understanding this foundational role is crucial for anyone aspiring to a leadership position in corporate finance. The controller acts as a bridge between operational activities and financial outcomes, translating complex financial data into actionable insights for management. This position demands a strong grasp of accounting principles, regulatory compliance, and internal control frameworks. Effective communication skills are also vital, as controllers frequently interact with various stakeholders, including executives, auditors, and other department heads. Ultimately, the controller ensures financial transparency and accountability across the enterprise, contributing significantly to the company's overall financial health and strategic direction. Key responsibilities of an accounting controller. The core responsibilities of an accounting controller are extensive and critical to an organization's financial well-being. These include overseeing all accounting operations, such as the general ledger, accounts payable, accounts receivable, and payroll. The controller is also responsible for the preparation of accurate and timely financial statements, ensuring compliance with relevant accounting standards like GAAP or IFRS. Furthermore, they manage the month-end and year-end close processes, which are crucial for reporting financial performance. This comprehensive oversight ensures that all financial data is reliable and readily available for internal and external stakeholders. Beyond operational oversight, controllers play a significant role in establishing and maintaining internal controls to safeguard assets and prevent fraud. They coordinate external audits, acting as the primary liaison between a company and its auditors. Budgeting and forecasting are also key areas where controllers collaborate with management to develop financial plans and monitor performance against those plans. Moreover, they often engage in financial analysis, interpreting trends and providing strategic recommendations to improve profitability and efficiency. This diverse set of duties highlights the controller's central position in financial governance. Organizational structure and reporting lines. The accounting controller's position within an organization's structure can vary, but typically they report directly to the Chief Financial Officer, CFO. In smaller companies, they might report to the CEO, or even directly manage all finance functions. This reporting line is crucial, as it determines the controller's level of authority and influence over financial decisions. A clear reporting structure ensures that financial information flows efficiently upwards, enabling senior management to make informed strategic choices. The controller often oversees a team of accountants, including general ledger accountants, accounts payable specialists, and payroll administrators, managing their daily operations and professional development. Understanding the organizational chart is vital for effective collaboration and communication within the finance department and across the company. The controller's team is responsible for executing the day-to-day accounting tasks that form the foundation of financial reporting. Their interactions extend beyond their direct reports to other departments, such as operations, sales, and human resources, to gather necessary financial data and ensure compliance with company policies. This interconnectedness highlights the controller's role as a central hub for financial information, requiring strong leadership and interpersonal skills to manage diverse relationships effectively. Financial Reporting Standards, GAAP, IFRS. Adherence to financial reporting standards is a cornerstone of the accounting controller's role, ensuring consistency, comparability, and transparency in financial statements. The two primary sets of standards are Generally Accepted Accounting Principles, GAAP, predominantly used in the United States, and International Financial Reporting Standards, IFRS, adopted by many countries worldwide. These standards dictate how financial transactions are recognized, measured, presented, and disclosed in a company's financial reports. Controllers must possess an in-depth understanding of the specific standards applicable to their organization to ensure full compliance. This knowledge is crucial for producing credible financial information that stakeholders can rely upon for decision-making. Navigating the complexities of GAAP and IFRS requires continuous learning and attention to detail, as these standards are regularly updated and interpreted. Controllers are responsible for implementing these standards within their accounting systems and processes, ensuring that all financial reporting aligns with the prescribed guidelines. They must also be adept at explaining the implications of these standards to non-financial stakeholders, clarifying how certain accounting treatments affect the company's reported financial position and performance. The ability to accurately apply and interpret these standards is fundamental to maintaining the integrity and trustworthiness of an organization's financial disclosures. Internal controls and compliance. Establishing and maintaining robust internal controls is a paramount responsibility for an accounting controller. Internal controls are processes designed to safeguard assets, ensure the accuracy and reliability of financial information, promote operational efficiency, and encourage adherence to management policies. These controls encompass a wide range of activities, from segregation of duties and authorization procedures to reconciliations and physical security of assets. The controller is instrumental in designing, implementing, and monitoring these controls to mitigate risks such as fraud, errors, and non-compliance with regulations. A strong control environment fosters trust and reduces the likelihood of financial misstatements. Compliance with various regulatory requirements, such as Sarbanes-Oxley Act, SOX in the US, is another critical aspect of the controller's role. This involves ensuring that the company's financial reporting and internal control systems meet legal and ethical standards. Controllers must stay updated on evolving regulations and adapt the company's processes accordingly. They often work closely with internal and external auditors to assess the effectiveness of controls and address any identified deficiencies. The proactive management of internal controls and compliance not only protects the company from financial and reputational damage, but also enhances its overall governance and operational effectiveness. Budgeting and forecasting process. The accounting controller plays a central role in the organization's budgeting and forecasting processes, which are vital for strategic planning and performance management. Budgeting involves creating a detailed financial plan for a future period, outlining expected revenues, expenses, and capital expenditures. This process typically requires extensive collaboration with various department heads to gather inputs and ensure alignment with organizational goals. The controller is responsible for consolidating these inputs, ensuring their accuracy, and presenting a comprehensive budget to senior management for approval. An effective budget serves as a roadmap for financial operations and a benchmark for evaluating performance. Forecasting, on the other hand, is a continuous process of predicting future financial outcomes based on current trends, historical data, and anticipated changes in the business environment. Controllers use various analytical techniques to develop financial forecasts, which are often updated more frequently than budgets to reflect dynamic market conditions. These forecasts help management anticipate potential challenges and opportunities, enabling proactive decision-making. The controller's expertise in financial modeling and data analysis is crucial for producing reliable budgets and forecasts that support strategic initiatives and operational efficiency. Cash flow management. Effective cash flow management is a critical responsibility for the accounting controller, as it directly impacts an organization's liquidity and solvency. This involves monitoring the movement of cash into and out of the business, ensuring that there is always sufficient cash to meet operational needs and strategic investments. Controllers prepare cash flow statements, which provide a clear picture of cash generated from operating, investing, and financing activities. They also develop cash flow forecasts to anticipate future cash positions, allowing management to make timely decisions regarding short-term borrowing or investment of surplus cash. Proactive cash management prevents liquidity crises and supports sustainable growth. The controller works closely with other departments, such as sales for collections and procurement for payments, to optimize the cash conversion cycle. They implement strategies to accelerate cash inflows, such as efficient invoicing and collection processes, and manage cash outflows effectively, often by negotiating payment terms with suppliers. Understanding the timing of cash receipts and disbursements is paramount for maintaining a healthy cash balance. By meticulously managing cash flow, the controller ensures the company's ability to meet its financial obligations, seize opportunities, and maintain financial stability in both the short and long term. Working capital optimization. Working capital optimization is a key area where the accounting controller can significantly impact a company's financial health and operational efficiency. Working capital, defined as current assets minus current liabilities, represents the capital available to a business for its day-to-day operations. Optimizing this involves striking a balance between liquidity and profitability, ensuring sufficient funds are available without tying up excessive capital in unproductive assets. Controllers analyze components like accounts receivable, inventory, and accounts payable to identify opportunities for improvement. The goal is to maximize the efficiency with which current assets and liabilities are managed. Strategies for working capital optimization include accelerating collections from customers, managing inventory levels efficiently to minimize carrying costs, and optimizing payment terms with suppliers. The controller collaborates with sales, procurement, and operations departments to implement these strategies effectively. For example, they might work with sales to improve invoicing accuracy and timeliness, or with procurement to negotiate extended payment terms without impacting supplier relationships. By effectively managing working capital, the controller helps improve cash flow, reduce borrowing needs, and enhance the company's overall financial performance and competitive position. This proactive approach ensures resources are utilized optimally. Financial statement analysis. Financial statement analysis is a crucial skill for an accounting controller, enabling them to interpret a company's financial health, performance, and future prospects. This involves scrutinizing the income statement, balance sheet, and cash flow statement to identify trends, strengths, and weaknesses. Controllers use various analytical techniques, such as ratio analysis, horizontal analysis, trend analysis, and vertical analysis, common size analysis, to gain deeper insights into the company's financial position. This analysis is not merely about numbers, it's about understanding the story those numbers tell about the business's operations and strategic decisions. The insights derived from financial statement analysis are invaluable for both internal management and external stakeholders. Internally, controllers use this analysis to provide management with actionable recommendations for improving profitability, efficiency, and liquidity. Externally, it helps in communicating the company's financial performance to investors, creditors, and regulatory bodies. A controller's ability to articulate complex financial information clearly and concisely is paramount. This analytical expertise allows them to contribute significantly to strategic decision-making, helping guide the company towards its financial objectives and sustainable growth. Cost accounting principles. Understanding and applying cost accounting principles is a fundamental aspect of the accounting controller's role, particularly in manufacturing or service-oriented businesses. Cost accounting involves collecting, analyzing, and reporting on the costs associated with producing goods or services. This includes identifying direct costs, like direct materials and direct labor, and indirect costs, like overhead. Controllers use various costing methods, such as job costing, process costing, and activity-based costing, ABC, to accurately determine the cost of products or services. This detailed cost information is essential for pricing decisions, profitability analysis, and cost control initiatives. The insights derived from cost accounting enable controllers to provide management with critical information for operational efficiency and strategic decision-making. By analyzing cost structures, controllers can identify areas for cost reduction, process improvements, and resource allocation optimization. They also play a key role in variance analysis, comparing actual costs to budgeted or standard costs to understand performance deviations. This detailed cost management expertise allows the controller to significantly contribute to improving the company's operational profitability and ensuring competitive pricing strategies, ultimately enhancing overall financial performance. Management reporting and KPIs. Management reporting is a crucial function of the accounting controller, providing internal stakeholders with timely and relevant financial and operational information for decision-making. Unlike external financial statements, management reports are tailored to specific internal needs and often include non-financial metrics. These reports typically cover areas such as departmental performance, project profitability, sales analysis, and operational efficiency. The controller is responsible for designing, preparing, and distributing these reports, ensuring they are clear, concise, and actionable. Effective management reporting empowers leaders to monitor progress, identify issues, and make informed strategic adjustments. Key performance indicators, KPIs, are central to effective management reporting. Controllers work with management to identify and track relevant KPIs that align with the organization's strategic objectives. These might include metrics like gross profit margin, customer acquisition cost, employee productivity, or inventory turnover. By regularly monitoring these indicators, the controller helps management assess performance against targets and identify areas requiring attention. The ability to translate raw data into meaningful insights through well-structured reports and relevant KPIs is a hallmark of a skilled accounting controller, driving accountability and performance across the organization. Tax compliance and planning. Tax compliance and planning represent a significant and complex area of responsibility for the accounting controller. This involves ensuring that the company adheres to all applicable tax laws and regulations at federal, state, and local levels. Controllers are responsible for the accurate and timely preparation and filing of various tax returns, including corporate income tax, sales tax, and payroll taxes. They must stay current with ever-changing tax legislation and interpret its impact on the company's financial operations. Non-compliance can lead to significant penalties and reputational damage, making this a critical area of focus. Beyond mere compliance, controllers also engage in tax planning, seeking legitimate strategies to minimize the company's tax liabilities while remaining within legal boundaries. This involves analyzing business transactions, investment decisions, and operational structures to identify tax-efficient approaches. They often collaborate with external tax advisors and legal counsel to develop and implement these strategies. Effective tax planning can significantly improve a company's financial performance and cash flow. The controller's expertise in this area is vital for optimizing the company's tax position and ensuring long-term financial health. Audit management and coordination. Audit management and coordination are key responsibilities for the accounting controller, serving as the primary liaison between the company and its external auditors. This involves preparing for the annual financial audit, which includes ensuring all financial records are accurate, complete, and readily accessible. The controller oversees the compilation of necessary documentation, schedules meetings, and addresses auditor inquiries promptly and effectively. Their role is to facilitate a smooth and efficient audit process, minimizing disruptions to daily operations. A well-managed audit process demonstrates the company's commitment to transparency and financial integrity. Beyond external audits, controllers also play a role in managing internal audits, if applicable, and ensuring that any audit findings or recommendations are addressed. They are responsible for implementing corrective actions for identified control deficiencies and continuously improving internal processes based on audit feedback. The controller's ability to effectively communicate with auditors, understand their requirements, and manage the flow of information is crucial for a successful audit outcome. This oversight ensures that the company's financial reporting remains credible and compliant with regulatory standards, strengthening stakeholder confidence. Treasury Functions Overview. While often a separate department in larger corporations, the accounting controller frequently has an overview or direct involvement in certain treasury functions, especially in smaller to medium-sized enterprises. Treasury functions primarily deal with managing the company's liquidity, investments, and financial risks. This includes optimizing cash balances, managing banking relationships, and overseeing short-term investments. The controller's deep understanding of cash flow and financial reporting makes them a natural partner in ensuring efficient treasury operations. They provide critical financial data that informs treasury decisions, such as when to invest surplus cash or secure short-term financing. The controller's involvement may extend to monitoring foreign exchange risk, interest rate risk, and commodity risk, especially as the company operates internationally or deals with volatile raw materials. They ensure that financial transactions are properly recorded and reported, even if the Treasury Department executes them. This collaborative role ensures that Treasury activities align with the company's overall financial strategy and risk appetite. By providing accurate financial insights and maintaining robust internal controls, the controller supports the Treasury function in safeguarding assets and optimizing financial resources, contributing to overall financial stability. Risk management in accounting. Risk management is an integral part of the accounting controller's responsibilities, focusing on identifying, assessing, and mitigating financial and operational risks that could impact the company's financial reporting and assets. This includes risks related to fraud, data security breaches, compliance failures, and operational inefficiencies. Controllers are instrumental in developing and implementing internal controls designed to prevent or detect these risks. They conduct risk assessments to understand the likelihood and potential impact of various threats, prioritizing efforts to address the most critical vulnerabilities. A proactive approach to risk management protects the company's financial integrity and reputation. The controller also plays a role in monitoring and reporting on the effectiveness of risk mitigation strategies. They work closely with IT security, legal, and operational departments to ensure a comprehensive risk management framework is in place. For example, they might oversee the implementation of new accounting software to reduce data entry errors or enhance cybersecurity measures to protect financial data. By continuously evaluating the risk landscape and adapting control measures, the controller helps ensure the reliability of financial information and the security of company assets. This strategic oversight is crucial for maintaining stakeholder confidence and supporting long-term business sustainability. ERP systems in accounting. Enterprise resource planning, ERP systems, are foundational to modern accounting operations, and the accounting controller plays a critical role in their implementation, optimization, and utilization. An ERP system integrates various business processes, including accounting, finance, human resources, and supply chain, into a single unified platform. For accounting, this means streamlined data entry, automated reconciliations, and real-time financial reporting. Controllers ensure that the ERP system is configured correctly to meet accounting standards, internal control requirements, and reporting needs. This integration enhances data accuracy, reduces manual errors, and improves overall efficiency. The controller acts as a key stakeholder in ERP system upgrades or new implementations, providing expertise on financial modules and ensuring data integrity during migration. They train their accounting team on system functionalities and best practices, maximizing the system's capabilities. Furthermore, controllers leverage the ERP system's robust reporting tools to generate detailed financial statements, management reports, and ad hoc analyses. By effectively managing and utilizing the ERP system, the controller ensures that the finance department operates with maximum efficiency, providing timely and accurate financial information essential for strategic decision-making and operational excellence. Data analytics for controllers. Data analytics is rapidly becoming an indispensable tool for accounting controllers, moving beyond traditional reporting to extract deeper insights from financial and operational data. Controllers leverage data analytics to identify trends, detect anomalies, forecast future performance, and support strategic decision-making. This involves using various tools and techniques, from advanced Excel functions and business intelligence software to specialized data visualization platforms. By analyzing large datasets, controllers can uncover hidden patterns, assess risks more accurately, and identify opportunities for cost savings or revenue growth. This analytical capability transforms the controller from a record keeper into a strategic business partner. The application of data analytics extends across many areas of the controller's responsibilities. For instance, it can be used to analyze accounts receivable aging to predict bad debts, scrutinize expense categories to identify inefficiencies, or evaluate sales data to understand profitability by product line or customer segment. Controllers must develop strong analytical skills and a data-driven mindset to effectively utilize these tools. The ability to interpret complex data and present actionable insights to management is crucial for driving performance improvements and guiding the company's financial strategy in an increasingly data-rich business environment. Ethics and professional conduct are foundational pillars for any accounting controller, underpinning all financial activities and decisions. Controllers are entrusted with sensitive financial information and hold a position of significant trust within an organization. Adhering to a strict code of ethics, which often includes principles like integrity, objectivity, professional competence, confidentiality, and professional behavior, is paramount. This ensures that financial reporting is unbiased, accurate, and reliable, fostering confidence among stakeholders. Any lapse in ethical conduct can lead to severe legal repercussions, reputational damage, and a loss of trust in the financial system. Controllers must navigate complex ethical dilemmas, such as pressure to manipulate financial results or disclose confidential information. They are responsible for promoting an ethical culture within their finance teams and throughout the organization. This involves leading by example, providing guidance on ethical issues, and ensuring compliance with company policies and professional standards. Professional bodies like the AICPA or IMA provide ethical guidelines that controllers are expected to follow. Upholding the highest standards of ethics and professional conduct is not just a regulatory requirement, but a moral imperative crucial for maintaining the credibility and long-term sustainability of the business. Leadership and team management. Effective leadership and team management are essential competencies for an accounting controller, as they typically oversee a team of finance professionals. This involves motivating, developing, and guiding their team to achieve departmental and organizational goals. Controllers must foster a collaborative and high-performing environment, providing clear expectations, constructive feedback, and opportunities for professional growth. They are responsible for delegating tasks appropriately, managing workloads, and ensuring that the team has the necessary resources and training to excel. Strong leadership ensures that the accounting function operates efficiently and effectively. Beyond day-to-day management, controllers also play a crucial role in talent acquisition and retention within their department. They identify skill gaps, recruit qualified candidates, and implement strategies to retain valuable employees. Mentorship and coaching are integral to developing future finance leaders. A controller's ability to inspire trust, communicate vision, and resolve conflicts within their team directly impacts productivity and morale. By building a strong and cohesive accounting team, the controller ensures the continuous delivery of accurate financial information and supports the company's overall strategic objectives, making them a true leader within the organization. Communication skills for controllers. Exceptional communication skills are paramount for an accounting controller, as they frequently interact with a wide range of stakeholders, both internal and external. Internally, controllers must effectively communicate complex financial information to non-financial executives, department heads, and their own accounting team. This requires the ability to translate technical accounting jargon into clear, understandable language. Tailoring the message to the audience's level of financial literacy, clear communication ensures that financial insights are understood and acted upon, driving informed decision-making across the organization. It also fosters transparency and builds trust. Externally, controllers communicate with auditors, bankers, investors, and regulatory bodies. They must be adept at presenting financial results, explaining accounting policies, and responding to inquiries with confidence and clarity. Strong written communication skills are equally important for preparing comprehensive reports, memos, and presentations. The ability to articulate financial positions, explain variances, and defend accounting treatments is crucial for maintaining credibility and compliance. Ultimately, effective communication allows the controller to influence decisions, build strong relationships, and ensure that the company's financial story is accurately and compellingly told to all relevant parties. Mergers and acquisitions accounting. Mergers and acquisitions (M&A) accounting is a specialized and complex area where the accounting controller often plays a critical support role. This involves understanding the financial implications of combining two or more entities, including due diligence, valuation, purchase price allocation, and post-acquisition integration. During due diligence, the controller assists in reviewing the target company's financial records to identify potential risks, liabilities, and opportunities. Their expertise ensures that the financial data used for valuation is accurate and reliable, which is crucial for determining a fair purchase price. This phase requires meticulous attention to detail and a deep understanding of accounting principles. Post-acquisition, the controller is responsible for integrating the acquired company's financial systems and processes into the parent company's framework. This includes harmonizing accounting policies, consolidating financial statements, and ensuring compliance with new reporting requirements. Purchase price allocation, which involves assigning the acquisition cost to the assets and liabilities of the acquired company, is another complex task that falls under the controller's oversight. The successful financial integration of an M&A deal is vital for realizing the strategic benefits of the acquisition. The controller's role ensures that the financial aspects of these transactions are handled accurately and efficiently, minimizing financial risks and maximizing value creation. International accounting considerations. For companies operating globally, the accounting controller must navigate a complex landscape of international accounting considerations. This involves understanding and applying different accounting standards, such as IFRS, when dealing with foreign subsidiaries or international transactions. Controllers must also be aware of varying tax laws, currency exchange rates, and regulatory environments across different countries. Consolidating financial statements from entities operating under diverse accounting principles requires specialized knowledge and meticulous attention to detail. The goal is to ensure consistent and accurate financial reporting across all global operations, providing a unified view of the company's financial performance. Managing foreign currency translation and hedging strategies is another critical aspect of international accounting. Fluctuations in exchange rates can significantly impact a company's reported earnings and financial position. Controllers work closely with treasury departments to manage these risks and ensure proper accounting for foreign currency transactions. They also ensure compliance with local statutory reporting requirements in each country of operation. The ability to adapt to diverse international accounting practices and effectively manage cross-border financial complexities is essential for controllers in multinational corporations, ensuring global financial transparency and compliance. Advanced financial modeling is a sophisticated skill that elevates the accounting controller's strategic contribution to an organization. This involves building complex financial models to forecast future performance, evaluate investment opportunities, assess the impact of strategic decisions, and perform scenario analysis. Controllers use these models to project income statements, balance sheets, and cash flow statements under various assumptions, providing management with a detailed understanding of potential outcomes. These models are crucial for capital budgeting, mergers and acquisitions analysis, and long-range financial planning. Proficiency in tools like Excel and specialized financial modeling software is essential. The controller's role in financial modeling extends beyond mere construction to interpreting the model's outputs and communicating their implications to senior management. They perform sensitivity analysis to understand how changes in key variables impact financial results, helping to quantify risks and opportunities. By providing robust financial models, the controller empowers decision-makers with data-driven insights, enabling them to make more informed and strategic choices. This advanced analytical capability allows the controller to move beyond historical reporting and become a proactive driver of future financial success, contributing significantly to the company's strategic direction and value creation. Performance measurement systems. Designing and implementing effective performance measurement systems is a key strategic contribution of the accounting controller. These systems go beyond traditional financial reporting to provide a holistic view of organizational performance, often incorporating both financial and non-financial metrics. Controllers work with management to define relevant key performance indicators, KPIs, that align with strategic objectives, such as customer satisfaction, operational efficiency, innovation, and employee engagement. The goal is to create a framework that allows for continuous monitoring, evaluation, and improvement across all business units. This systematic approach ensures that the company is on track to achieve its goals. The controller is responsible for collecting, analyzing, and reporting on these performance metrics, often utilizing dashboards and balanced scorecards to present information clearly. They interpret variances from targets and provide insights into the root causes of performance gaps. This involves collaborating with various departments to ensure data accuracy and consistency. By providing a robust performance measurement system, the controller empowers managers to make data-driven decisions, allocate resources effectively, and drive accountability throughout the organization. This strategic oversight helps to translate strategic vision into measurable outcomes, fostering a culture of continuous improvement and achieving sustainable competitive advantage. Strategic financial planning. Strategic financial planning is a high-level function where the accounting controller contributes significantly, moving beyond historical reporting to shape the company's financial future. This involves collaborating with senior management to develop long-term financial goals and strategies that align with the overall business objectives. Controllers provide critical financial insights, projections, and risk assessments that inform strategic decisions, such as market expansion, new product development, or capital investments. They help translate the company's vision into a quantifiable financial roadmap, ensuring that resources are allocated effectively to achieve strategic priorities. This proactive involvement is crucial for sustainable growth. The controller's role in strategic financial planning includes evaluating the financial viability of various strategic initiatives and assessing their potential impact on profitability, cash flow, and shareholder value. They develop financial models to simulate different scenarios, helping management understand the financial implications of alternative strategies. Furthermore, they monitor the execution of strategic plans, tracking key financial metrics and providing feedback on performance against strategic targets. By integrating financial expertise with strategic thinking, the controller acts as a vital partner in guiding the company's long-term direction, ensuring financial sustainability and maximizing shareholder returns. Future trends in accounting. The field of accounting is continuously evolving, and the accounting controller must stay abreast of future trends to remain effective and strategic. Key trends include the increasing adoption of artificial intelligence, AI, and machine learning, ML, for automation of routine tasks, predictive analytics, and fraud detection. Blockchain technology is also gaining traction for enhancing transparency and security in financial transactions. Controllers need to understand how these technologies can be leveraged to improve efficiency, accuracy, and insights within the finance function. Embracing these innovations is crucial for maintaining a competitive edge and driving digital transformation. Another significant trend is the growing emphasis on environmental, social, and governance (ESG) reporting. Controllers are increasingly involved in collecting, verifying, and reporting non-financial data related to sustainability and corporate responsibility. The demand for real-time data and continuous auditing is also rising, requiring controllers to implement more agile and responsive accounting systems. Furthermore, the role of the controller is shifting from a traditional record keeper to a strategic business partner, requiring enhanced analytical, technological, and communication skills. Adapting to these future trends ensures that the accounting function remains relevant and adds maximum value to the organization.